Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everybody, and welcome back to another episode of Blind Spots. In today's episode, we are going to be talking about how all advisors are not the same. There is a common misconception in this industry that all advisors are the same, and we know that this couldn't be further from the truth. So that is what we are going to be breaking down today.
So I think there's a few things here. One, it is difficult to choose an advisor. There's a lot of misinformation out there. Many of these firms spend millions on advertisements and social media posts and yada, yada, trying to get your attention, trying to explain how they're different. And a lot of it is nonsense. A lot of it is snake oil. So we're going to unpack a lot of this to help you make a better decision. And then the second part is this is for people, consumers that want advice, but they also want a human component to that advice. So this isn't talking about a do-it-yourself platform or a trading platform. This is for people that want to work with a human advisor on some level. So we're going to look at the opportunity set, right? The low-cost leaders, the vanguards of the world. On the other end, the Wall Street firms, the brokers, and then we'll also look at firms like Pure Portfolios, which are independent firms, and how they operate and the pros and cons of each of those types of advisors.
So let's lay the groundwork with the different firm types, because where an advisor works makes a big difference on the type of service and options that they deliver to you. So let's start with the Wall Street big banks.
Yeah, and I think you can even break this down at a higher level. And what I mean by that is I'm a firm believer that humans respond to incentives. If you've read the blog, if you've heard me speak, I am a big believer that incentives drive human behavior. It doesn't matter if you're a good person, a bad person, either consciously or subconsciously, the incentives in front of you are going to drive your activity day in and day out. So let's take it a level higher. Public companies versus non-public companies. Usually this is not a big deal when you're working in other types of businesses. I mean, maybe it could be a big deal, but public companies have a legal obligation to maximize the bottom line. They have a legal obligation to squeeze everything out of the business to make money for investors, to make money for the people that own that company's stock. Okay? So if you're working with an advisor that works at one of these public companies and they have to choose between doing right by you, doing right by the client, or maximizing the bottom line, which one of those do you think wins?
And someone might say, oh, they have a fiduciary duty, yada, yada. We'll get to that later.
Hey, I've sat in those sales meetings at huge public company bank. I can tell you the client outcome is never discussed, ever discussed. It's about what have you brought in? What are you bringing in? What have you done for me lately? What have you cross-sold to commercial banking? What have you cross-sold to retail banking? How many credit cards did you sell? It's never ending. They're always trying to maximize, to monetize the client relationship, and they always want to do more of it. They want you to focus your time on bringing in business, and they structure your incentive plan, your compensation plan to bring in additional assets or to sell products. Now, that's fine. That's one way of doing it. But how is that good for a fee-paying existing client? Like if you're a client of that company, how is that good for you? It's not. It's not, because the person that should be minding the shop is out there beating the pavement trying to bring on more clients or assets.
I think that paints a pretty accurate and fair picture of the publicly traded side of things. How about privately owned?
Private businesses have autonomy. They can do what they feel is right. So I talked about my experience at a public company. Pure Portfolios is a private company. We don't answer to Wall Street. We don't answer to a board of directors. We do not have to maximize the bottom line. We only answer to our clients, and we only get paid by our clients. That allows us to focus on client outcomes. That allows us to have a lower fee structure. That allows us to invest and write and do what we think is best for our client base. Okay, 99.9% of our time is spent on talking with clients, on writing investment content, on producing podcasts, on trying to educate people to make better decisions, on our investment process, on trying to improve the client experience. We don't have any salespeople. We don't have any sales goals. Okay, like we're not asking our advisors to go out and write down the names of your 30 closest friends and family. Like, no one's doing that. We're not knocking on doors. Through our content, through our podcast, through our videos, people find us. That frees us up to focus on what's important, and that's our client's outcome.
So somewhere in the middle, how about robo-advisors? Usually publicly traded, not always, but a different feel and environment.
Yeah, so when I say robo-advisor, or when Erin says it, we're really talking about Vanguard and Betterment. So those companies have done a lot to lower the overall cost for the retail investor. And Vanguard is a behemoth. And what Vanguard has hung their hat on is low cost investing, right? It's great for people that have a simple situation, that just are very fee sensitive and want a low cost way to get advice and to speak to a human when they have a question or if markets are going down. So that's fine. There's nothing wrong with the Vanguard service, and I'll never say anything wrong about Vanguard. Okay, they're completely fine for many people. The drawbacks of Vanguard are it's not a personal service. So if you're working with Vanguard, you are working with an advisor with probably 10,000 clients sitting in a call center on the East Coast. Okay, given their fee structure and given their service model, you're not getting a personalized service. You're going to get the same advice that they give everybody else, which again is fine if you're sensitive about fees and your balance sheet is pretty clean and straightforward. Okay. If you work with a Vanguard advisor, you might work with a different advisor each time. People move on. I mentioned the client loads during periods where the market is acting crazy. I've heard there's wait times. So again, you might not speak to the same advisor. You might be on hold for an hour. Not ideal for someone that wants their hand held. Okay. And over the last couple of years, Vanguard has gotten flack over capital gains that have been passed on to their clients. So a client could own a mutual fund in a taxable account. The client doesn't sell that fund, but Vanguard, as they rebalance that fund, has caught flack for passing long-term or short-term capital gains onto their clients and saddling them with a tax bill at the end of the year. And oftentimes it's a surprise. So when you talk about a custom portfolio or a personalized portfolio, Vanguard is not offering any of that. Quite the opposite. And sometimes that can come with a large tax bill, which is not ideal.
So we covered a lot in just the different types of firms that are available. But let's drill down into each of them, starting with fees, because that's where there's a pretty good differentiator.
Yeah, so the Vanguard fee, if I could just quote that. So they have an advisor services platform, which is basically access to a CFP, so a certified financial planner, for 0.35% or a little more than a third of 1%. Okay, so that includes meetings, access to the financial plan. They'll build a financial plan for you. They'll build a portfolio for you. And again, you can call in and talk to that advisor. It might be a different advisor, but you can call in and talk to somebody if you have a question.
How about the high cost Wall Street firm?
High cost Wall Street. Man, it's okay. So the standard Wall Street advisor fee is a 1% fee. So 1% multiplied by the dollar amount that you have invested with that advisor. So let's say you've got $1 million with a big public bank, right? And that advisor is charging you a 1% fee. You are going to pay roughly $10,000 each year to work with that person. Now, where Wall Street gets you, well, I mean, they get you in a few different ways, but one of the most common ways Wall Street gets you is high cost funds that they use to build out your portfolio. So oftentimes these big Wall Street firms will get paid by mutual fund companies to use their mutual funds. Okay, so that's a conflict right there, right? Because who's to say the funds the advisor is using and getting compensated for are the best for your portfolio, right? You know, it'd be very hard pressed to pass that off to the SEC saying, oh, yes, I received a kickback from this fund company, and it also was the best fund for my client. That's hogwash. Advisors get dinged for that all of the time. Okay. And those mutual funds, which your advisor could be receiving a kickback from, are often very expensive, right? So they could cost another 1% to the client. But the thing about the mutual funds, the high cost mutual funds, that fee doesn't show up on your statement. That fee doesn't show up anywhere. Your advisor's not talking about it. So all of a sudden, you're paying your advisor a 1% fee plus a 1% fee for the mutual funds, which could be a little more, it could be a little less. But you add those two up, and all of a sudden, you're at a 2% fee. So instead of $10,000 a year, you're paying $20,000 a year. That's a tough hurdle to jump over.
Do you have a video on that you break down the fees in mutual funds? I feel like you do.
Yeah, so I've wrote a lot about this. We have a cost of investing spreadsheet that we use that show advisor fee plus cost of owning the assets, like the mutual funds, equals in percent and dollar amount per year to help people understand what they're paying versus what they could be paying at Pure or what they're paying at Vanguard. So we just use it as a comparison tool because oftentimes, I mean, I can't tell you how many times a new prospective client thinks they're getting advice for free or thinks their advisor doesn't charge them a fee or has no clue what they're paying. That is an egregious mistake.
Okay, how about Pure portfolios?
So what Pure has aimed to do, what I wanted to do was create kind of a hybrid model. So our niche is low cost, human driven advice, right? And we found that humans want advice. People want advice and they want to work with other humans, but they don't want to pay up for it. Like they don't want to pay a 1% fee to a Wall Street advisor and then another 1% for the mutual funds. Okay. So what we've tried to do is offer a lower fee service powered by technology and human advice. And our fees start at 0.65% or 0.6%. So slightly more than Vanguard, right? But you're getting a higher touch service. You're getting a custom portfolio, perhaps. You're getting a financial plan. You're getting a dedicated advisor. If you call us, we will answer the phone. You know, we also give tax guidance and estate planning advice. We do behavioral coaching. So that fee's slightly more than Vanguard, but much less than Wall Street. Okay. And that's kind of been our niche. So if we sit across the table from a prospective client that's working with a big Wall Street firm, our conversion rate is quite high. So what we're trying to do is rescue people from those high cost, conflicted advisors and just give them a more friendly umbrella. So we've taken kind of the best of what these higher cost advisors do and what they build their business around is this personalized service. Like, oh, hey, I'm going to take care of you, buddy. But on the back end, they're charging an arm and a leg. And we're marrying that with this lower cost, streamlined, technology heavy offering. And that's Pure Portfolios.
So in talking about the different types of firms, we touched a little bit on mutual funds and investment selection, but I had just briefly sprinkled in the fiduciary responsibility. So go through the responsibilities within each of those different firm types.
So there's the SEC way of describing what a fiduciary is. And what a fiduciary is by law, you have to do right by your clients. Like you can't put your bottom line ahead of clients. You can't sell things your clients don't need just so you can make money off of it. Okay. So by law, a fiduciary is doing right by your clients. Vanguard doesn't sell anything. As I said, they've done more to lower the overall cost for the retail investor. Vanguard is a fiduciary. Okay. Wall Street might put themselves out there like they're a fiduciary, but given what we've outlined, right, when push comes to shove, between maximizing the bottom line and doing right by your clients, the former is always going to win. And it's not just me saying this. There's a site that tracks corporate fines. And financial services, big banks lead in corporate fines year over year. And the reasons why they get fined change, but there's a pattern of bad behavior, right? Like people think that just because a big Wall Street firm has been in business for 100 years, that they're a good actor. I would argue that's a dangerous assumption. Erin, do you have something?
Goodjobsfirst.org.
Goodjobsfirst.org.
Violation tracker.
Violation tracker. So you can see every SEC fine and violation for a big Wall Street broker, insurance company, and bank. And they are by far, again, the leader, the all-time leader of fines. And it's consistent. They're the all-time leader, but also the leader year in and year out. So don't think because you work with a big name that they're acting in good faith and acting in your best interest, because that's not the case. And conversely, people think, if you work with a smaller firm, that your risk is higher of getting ripped off. And that, I'm not going to talk in absolutes. There's certainly small firms that don't do right by their clients, but it's not a reasonable assumption to assume just because a firm is big and publicly traded that they're somehow safer than a smaller firm that's private.
A funny point that often comes up when we are talking with clients who are interested in ESG investing is oftentimes many of those funds have some sort of publicly traded big bank or firm in their top 10 holdings. And so while maybe they're doing a good job on the environmental side, it's interesting just to have the conversation with the client of what types of values they want expressed in their portfolio. And oftentimes they're making a trade-off for one over another in terms of values-based investing.
Yeah, that's one thing I've always had a problem with on the ESG front. And the ESG investing theme is, investors wanting to use their capital for good and investing in companies that might invest in their communities or have an environmental goal to help with global warming or what have you. But a lot of these ESG companies, right, that people think are friendly to their communities or the environment or what have you, are some of the worst offenders out there. Like to me, the biggest banks in this country have a track record of ripping off the American public. How can they be the biggest holding in an ESG index? Like that makes no sense. Like on the front door, yeah, we're investing money in our communities and yada, yada. But on the backside, we are ripping off the American public and trying to fleece them for billions of dollars in profit. Like that just doesn't sit well with me.
Yeah, that's an interesting point.
So Pure is a fiduciary. We are a registered investment advisor by law. We have to act in the best interest of our clients. We don't have salespeople. We don't sell things. We don't use high cost mutual funds. We don't use annuities. We don't sell life insurance. We don't sell a damn thing. Okay. We only get paid from our clients. Our fees are itemized on their statement, which they get once a month. We show net of fee performance in their client portal. If someone wants to know what they're paying, we're very forthright with that information. Our fees are plastered on our website. If you don't know what you're paying your advisor, or if you think it's free, especially if you work for a big Wall Street firm, you need a reality check. That's just not what's happening. So make it clear. Make your advisor, if you don't know what you're paying, put it in writing and tell them that you want the advisory fee, the cost of owning the assets, like the mutual fund fees, and any other fee that they could possibly charge you. In a couple examples. One, if you're buying and selling something, sometimes there's a fee if you work with a big Wall Street firm. Okay. If you're getting sold an annuity or getting sold a whole life insurance policy, know that your advisor is going to make a huge commission off of that sale. Understand the incentives to understand the advice.
There's a really great blog that you wrote about evaluating a financial advisor. There is kind of a points system along with it. So we'll link that in the show notes. But I think it's kind of an interesting test if you were to hand this over to an advisor that you are interviewing, if they are able to answer those questions or pass the test, or even willing to answer the questions. That would be a good test.
Well, if you're speaking to an advisor, get their offer get what they're promising you in writing. Okay. Because there's a saying in our business, the biggest liar gets the business. And I can tell you, when an advisor needs to bring in assets or needs to sell something to feed their family, they will say whatever they can to get the business, right? So make sure you get it in writing. Make sure you understand the scope of service, the fees, the all-in cost of investing. Get it all in writing.
Yeah, we talked about that in our podcast episode of how to choose a financial advisor. So there's lots of questions listed in the show notes of that podcast episode, but it's also just a good episode if you are in the market for a new advisor.
So if you can't tell where we would suggest someone that wants an advisor to look, I think Vanguard is fine. Vanguard's great for those that are sensitive about fees and have a simple balance sheet, a simple situation. Vanguard's completely fine. I'll never say anything bad about Vanguard. In 2022, if you're working with a big Wall Street firm, I think you're doing it wrong. There's a much more friendly place for your capital. I mean, you've spent your whole life building, saving. Find a better place for your funds, okay? It's just, the track record is there, the high costs, the conflicts of interest, the misaligned incentives, the cross-selling, the sales culture, the SEC fines. Check out the Google reviews for a lot of these places. Check out Glassdoor and hear from the associates that work in these places. It's a bloodbath. Like, they have nothing good to say about any of these firms, but yet trillions of assets are still sitting there because people don't know any better, okay? And in our opinion, I'm not saying Pure Portfolios is the best place out there, right? Because that would be an egregious claim. But an independent registered advisor that's a fiduciary, that is an independent company, that doesn't answer to Wall Street, that doesn't answer to a board of directors, that doesn't do everything to maximize their bottom line, that's where you should look. That's a friendly neighborhood. But I will caution you that a lot of RIA founders, a lot of registered investment advisor founders come from Wall Street, okay? And it's my opinion that you can take an advisor out of Wall Street, but you can't take the Wall Street out of an advisor, okay? And what I mean by that is I've seen so many RIAs start, and when you look at the company that they set up, so they go from a big Wall Street firm, they start their own firm, an RIA, a fiduciary, but they're doing the exact same thing they did at their previous employer. Exact same fees, exact same investment approach, exact same funds, exact same everything. And it's like, look, man, you have an opportunity to do something different. You have a blank canvas and you've got a bunch of paints in front of you, and you paint the same exact picture that was drawn at the place that you just left. Like, to me, that's more of a money grab. That's not very inspiring. So find an RIA that's actually trying to do things differently. Find an RIA that's transparent and open, that is a fiduciary, that writes their own content, that basically is an open book, that is challenging the status quo. That's really what we're trying to do at Pure. I've come to realize that the status quo, the antiquated old Wall Street playbook, just is not going to work for the next 10 to 20 years. It's just not. So it's 2022. A lot has changed. It's time for people to wake up, look at the opportunity set of advisors, and find a better place for their hard-earned money.
Yeah, I think you said it best yesterday when we were preparing for this podcast episode, but a lot of advisors that come from Wall Street firms, they still get the same pie, but they're getting a bigger piece of it. Doing the same exact thing, whereas maybe you got 60% of revenue, now you get 100%.
Yeah. So in the next podcast, we are going to talk about things people anchor to when hiring an advisor that they shouldn't, right? And I think there's 3 or 4 things. There's common pitfalls that people make and assumptions that people make that usually result in a disaster.
I'm excited for that episode.
So people might perceive me to come off as a rambling idiot, and that's fine. I'm very passionate about this stuff, but my opinions are shaped based on what I see. Like, I'm not making this stuff up. Mm-hmm. We've brought on a decent amount of assets this year, and most of our clients come from high cost advisors, from big Wall Street firms, from strip mall advisors. And I'm just communicating what I'm seeing. These advisors that they're coming from are fleecing these people. They're taking complete advantage, and they've been doing it for decades. Kudos to the clients that poked their head up and said, this doesn't pass the smell test. Something's wrong. And they come to us and we're rescuing them, and we get great satisfaction of saving someone $15,000 or $20,000 a year and building an evidence-based lower cost portfolio and helping them identify their blind spots and building a actionable plan. So this is not me just going off the rails. This is based on what I'm seeing.
Mm-hmm. Yeah, it's a hot topic over here. We talk about it a lot, but it's a good one that people, we think, need to hear. So thanks for listening to this episode of Blind Spots. We will see you in the next one.